Tuesday was the first day that negative interest rates, announced by the Bank of Japan in late January, came into force. Superficial effects are already everywhere. There is the debt restructuring agreement between GLPJ REIT and Nomura, in which the former will be paid about $5,000 per year to borrow $47 million. There are the multiple suspensions of money market funds and the pleas by their managers for negative interest rate exemption. There is the abrupt decision by Japan Post Bank to cancel the launch of a Japan-US government bond fund for fear it could not be managed stably. Unsecured interbank overnight call rates falling to zero on Tuesday, and the admission by at least two of Japan's megabanks that parts of their systems were unable to handle negative rates, completed an unsettling picture. But the more fundamental weirdness in Japan was in place well before negative interest rates. Tokyo stocks are trading like a commodity, and the general Japanese public, voraciously turning the Nikkei 225 leveraged exchange-traded fund into the most traded ETF in the world, has effectively become an on-off program trade. It's quite a spectacle. The Tokyo stock market, over 2,000 corporates representing a developed economy, has recently lurched in ways that one strategist describes as ridiculous, and others admit they can no longer parse. There are numerous factors behind the moves, not least the intensified, algorithm-driven correlation between bonds, stocks, oil, and currencies. But within that, Japan has become uniquely binary, an unnuanced buy-sell on Abenomics, the yen, or China. Much of that appears to be the work of foreign investors, but that leveraged ETF, which is a favourite of retail investors in Japan, turns the whole market into a yes-no question. It behaves, in the words of one analyst, like a pre-2008 bank manager who would lend to anyone, and it's a clear exacerbating factor in the negative rates fallout.